I built a billion-dollar whiskey brand by honoring the legacy of a forgotten legend, but I still ended up going bankrupt.
This is Pocket Watching with JT.
Hey, Pocket Watchers, I am certified financial planner Jayson Thornton, and this is the Bankruptcy Breakdown. This is where I react to the financial failures of your favorite celebrities and influencers so you can get the financial lesson without going through the trouble. Let's go Pocket Watching. On this episode, I will be reacting to the very recent bankruptcy filing of the whiskey brand Uncle Nearest. But before I dig into the numbers, we have to give this brand and its founder their flowers. The Uncle Nearest whiskey brand was spearheaded and founded by Fawn Weaver. Fawn Weaver is a woman with a very extensive history in business, starting all the way back in the 1990s. At the very early age of 18, this woman started her own public relations company, then transitioned that success in the early 2000s into the restaurant and hospitality industries. She was able to once again find success in that industry, then transition that into investing in real estate and tech companies. Now, in 2016, while reading an article in the New York Times, she discovered the story of Uncle Nearest. Well, who is Uncle Nearest? Based on the story that she was able to read in the New York Times, she discovered that Jack Daniels, yes, the Jack Daniels of the billion-dollar whiskey brand, he was taught how to make whiskey from an unknown, forgotten hero and former slave, Nearest Green. While reading this story and understanding that there is a brand that should be known and recognized for the genius of Nearest Green, Fawn Weaver decided to honor his legacy by creating the Uncle Nearest whiskey brand. Now, this woman, through her sheer will and her ability to share the story of who Uncle Nearest was, she was able to build a brand. Get this, build a brand starting in like 2018. The woman was able to build a brand with the valuation over $1 billion. Not only that, she was able to start generating revenue of over $100 million annually by 2022. She also was able to get so many awards. Her brand became the most awarded whiskey brand in the country. She was even featured in Forbes magazines and all the familiar places for highly successful businessmen and women. So the question we have to ask is, how do we end up here? How do we end up at the bankruptcy breakdown with all of that going on? She built a brand that was worth over $1 billion, generating hundreds of millions of dollars every year. And she was honoring the legacy of a former slave who helped another man build a $1 billion brand. How do we end up here? Well, Fawn Weaver filed for Chapter 11 bankruptcy for the Uncle Nearest whiskey brand and all of its affiliates on March the 17th, 2026, only 2 days before the recording of this episode. So what happened? Well, in July 28, 2025, they were sued. Yes, the company was sued by a lender company by the name of Farm Credit Mid-America. Well, what are they claiming in this suit? Well, they were claiming that the Uncle Nearest brand defaulted on a loan totaling over $108 million. Well, what were the allegations? Well, the lender was claiming that Uncle Nearest provided inaccurate reports, overstating its whiskey barrel borrowing base for an amount of around $21 million. What are you saying, JT? Let me break this down. When the Uncle Nearest whiskey brand was signing up to get this loan for over $100 million, they were placing their inventory, barrels of whiskey, placing their inventory as collateral. The problem is, according to the lending institution, they said that the dollar amount, the value of their inventory was overstated by $21 million. Not only that, they said, hey, we don't like the way you're using the money we lent you. They said that $2.3 million of the loan was used to buy a luxury home in Martha's Vineyard. Not only that, they said that the company failed to maintain a net income of at least $1 per month, which was a part of the agreement. What does that mean? Well, when they came to the agreement of the loan, they wrote a condition into that agreement that stated, hey, this company has to maintain some kind of positive net income every month. If you do not have a positive net income every month, then we are going to claim that you defaulted on the loan, and we're going to have the ability to call the loan immediately. That's why they have in there that they have to have at least a $1 positive net income every month. If not, then you default. In the lawsuit, the lending institution, they made a request. They wanted the court to intervene and say, we need to put someone else in charge of this company so that we can ensure that we're going to get paid. Now, of course, Ms. Weaver and the company had an opportunity to explain themselves, to try to figure out what's going on, to defend these allegations. What was their defense? Well, the main defense was the problem was the CFO. Yes, the chief financial officer of this company. They were the problem. A man by the name of Michael. They said that Michael was the one that was engaging in fraudulent activities, not the company itself. It was this rogue financial guy. He was the one that was the main point of contact when it came to dealing with this loan and certifying how much collateral, how many barrels of whiskey they had. It was Michael's fault. The problem with that is this. When you run any type of business or organization and you give power through an agent, right? You give power through some sort of employee, a manager, someone, and they commit some sort of fraud in the name of the company itself is bound by those actions. That's why you have to be very careful who you hire and who you empower within your organization. So that's not a very strong defense, to be honest. It's not. When you put someone in place to have power to go out and get loans, sign documents, bind the entity to certain agreements, well, then you have to take blame for their bad actions. Not only that, though, they also said, hey, listen, you guys were aware that we bought the home in Martha's Vineyard. We even invited some of the executives out for our events. So why do you have a problem now? Well, the reason why they probably have a problem is because they stopped making payments on the debt. That is always an issue when you stop making payments on the debt. So what did the court think about all of this? Was, Uncle Nearest able to explain themselves? Well, apparently not too well. Because in August of 2025, a federal judge approved the emergency motion, placing Uncle Nearest Incorporated and its affiliates into receivership. What does that mean, JT? That means now the court is placing someone over the company, stripping Fawn Weaver and her husband from their normal management powers. They put a man by the name of Philip G. Young Jr. They appointed him to oversee the operations of the company moving forward so they can figure out what's going on and hopefully get the people who are owed money paid. All right. Now, what did this man find? Well, according to his reports, I didn't do the report. He did. According to his reports, he found that the company had basically a financial mess. Yeah, they said that things were missing, records were deleted. It was extremely difficult to try to reconcile the books because of the way that they were keeping their records. He also discovered, kind of odd, a company with $1 billion brand that I believe started around 2018. They hadn't filed a federal tax return since 2019. That's a red flag. Also, they said that there was a extreme lack of internal controls. Being able to make sure that there were responsible and somewhat accurate financial reports was extremely hard because of the lack of internal controls. Another issue that they found was co-mingling of funds. Always a bad thing. What are we talking about? Well, according to the report, they said about $16.6 million worth of transfers were going and flowing between multiple business entities owned and controlled by the Weavers. What's the problem with that? Well, the problem is, according to the receiver, that there was very little documentation of the use and the purpose of all of these transfers between these multiple entities. Well, see, the problem when you have lack of documentation, when you have lack of structure within the organization, you have the ability for some outside organization to do what's referred to as piercing the corporate veil. Well, what the heck does that mean, JT? Well, let's give a little lesson on LLCs for a moment, right? LLCs, incorporations, business entities. Let me explain the purpose of all of this stuff. Well, when you start an LLC, you are creating a limited liability company. You are basically creating almost a whole nother person on paper. Why is that important? It's important because this whole other person, this LLC or this corporation, has its own responsibilities, its authorities, and rights. When you own an LLC or a corporation, if someone wants to come after that corporation, they normally cannot then go after you as the individual owner. There is a wall of separation between the company and the people who actually own the company. The problem here is when you commingle funds, you are giving the people who are coming after you a crack in the door to come through and say, you know what? Even though on paper, you're saying that these companies are different companies with their own organization, with their own structure, their own liability, but we believe you are treating these companies as alter egos. What does that mean? That means if you are treating all of these companies truly as just one big company and you're floating around $16.6 million of the money we lent you and you're flowing it from one spot to the other spot without any type of record of what was the purpose of these transfers, are these loans? If they are loans, what's the term of the loans? Now the receiver has the ability to say, hey, all these other entities where you're flowing the loan money through, I want to take control of all of them. And that is exactly what the receiver did. He asked the judge to expand the receivership to cover all of the related companies, not just Uncle Nearest, but all of the related companies that Fawn and her husband Keith were in control of. Woo! All right, what else did he find? Well, based on his report, he said the company was bleeding money in the amount of about $1 million per month. And he said the company was basically insolvent. So, what is this woman going to do? She has lost control of a brand that she started from scratch and built it up to a $1 billion valuation. She has some man that she's never met before now controlling the company and threatening that he's going to sell off as much as he can to pay off the debt. What can this woman do? Well, she got the bright idea. I am going to file for Chapter 11 bankruptcy. Yes, for those of you who are still unaware, I'm going to continue to explain. There's different types of bankruptcy. There is the Chapter 7 liquidation bankruptcy. That's the type of bankruptcy that everyone thinks of when they hear the term bankrupt. It is the total liquidation, fresh start bankruptcy. It's a fairly quick process when you look at it at a full view. It can take between 4 to 6 months. You have certain assets that are going to be exempt, things that you can keep no matter what. Anything over the exempt assets, the court will take control of those assets, sell them off, pay off as much of the debt as possible, but whatever is left is wiped away. You are discharged from that debt and you're able to start your new debt-free life. That is not the type of bankruptcy that Miss Weaver filed. She filed for Chapter 11 bankruptcy. Chapter 11 bankruptcy for businesses and Chapter 13 bankruptcy for individual. These are the payment plan bankruptcies. These are the type of bankruptcy payment plans that last between 3 to 5 years. You set up an arrangement with the people who you owe money to. You set up a payment plan, and by the end of that payment plan, you are going to be in a position where the secured debts should be in good standing, are paid off, and whatever remaining unsecured debts are wiped away, discharged. That is generally how a Chapter 13, which individuals file, and a Chapter 11, where mostly businesses, but also individuals can file for Chapter 11 as well. And as you can see, on March the 17th, 2026, Fawn Weaver filed for Chapter 11 bankruptcy. She signed it saying that she is the authorized person for this company to file for bankruptcy because she is the CEO, the Chief Executive Officer. Now, why would she do that? Well, she did it because when you file for bankruptcy, you get what's referred to as an automatic stay. An automatic stay is a court order letting all of the creditors know that, hey, this person has filed for bankruptcy. You have to immediately stop your attempts to collect on a debt, and you have to come to the negotiation table and deal with your debtor. So it's a great strategy. Great strategy. She saw that this man was going to sell off all the things that he considered were non-core business assets, like the house in Martha's Vineyard and all these other things that he considered were not very important to the growth of the company and the brand. Now everything has to stop. Great idea. Now, this woman took to social media and she declared that the receivership is over. She has made the bold choice to file for Chapter 11 bankruptcy and take back control of the brand that she built. One of the things that I noticed immediately was one of the very top comments on her post. I saw a very familiar face. I saw Pinky Cole made a comment on this post. For those of you who are unaware, we recently did an episode on Pinky Cole here at the Bankruptcy Breakdown Pocket Watching with JT. And I noticed that our comments was very simple. She said, so proud of us in capital letters, so proud of us. Teach the people, love you. Because, of course, she recently filed for bankruptcy herself. Now, one main difference between the bankruptcy that Pinky Cole filed and the bankruptcy that Fawn Weaver filed is that Fawn Weaver actually hired an attorney to draft and file the bankruptcy. Miss Pinky Cole, she decided to file the bankruptcy on her own. It wasn't typed up. It was handwritten with, I believe, a blue ballpoint pen. So there's different levels to how a person can file for bankruptcy, and they're not exactly the same here, but I understand the sentiment. She was just trying to give support to her sister who also had a multi-million-dollar brand and recently filed for bankruptcy. Now, I normally would tell you about the company's income and the company's expenses at this time, but I can't. The reason why I can't is because the company's monthly income and the company's monthly expenses were not included in this initial bankruptcy filing. The only thing that I can break down for you guys is the debt. Okay, so we have debt in different categories. The first one is the secured debt. Okay, well, the number one secured debt that the company has is to the company Farm Credit Mid-America. They are owed, according to the bankruptcy, over $108 million. To be exact, $108,245,828.22. Now, the collateral based on the agreement is all of the debtor's assets and property. All, capital letters, ALL, all of the company's assets and property are collateral for this debt. Now, they're saying that the collateral is worth over $500 million, $528,745,000. So if we can sell off these assets, then the company should be able to get paid off. So that's not a problem. Shouldn't be a problem. But the issue is, I don't believe that Miss Weaver wants to deal with these assets just being sold off by some man she doesn't know. Well, what about the unsecured debt? Well, based on the bankruptcy, there is over $13 million worth of unsecured debts. She owes over 200 creditors. But what she does not have priority unsecured debt. Well, what's priority unsecured debt? Priority unsecured debt is debt that you owe to like the IRS. Now, one of the reasons why she probably does not owe the IRS is because the company's not making a profit. You normally only owe taxes when you make a profit. So if the company is blowing through $1 million a month, it most likely does not owe the IRS because they have not generated a profit. Now, what is going on at this point? This woman has filed for Chapter 11 bankruptcy. She has received her automatic stay. Now the receiver is blocked from selling off the assets, and she is fighting for control of her brand. What could the receiver do? Well, according to the bankruptcy filing, the receiver filed a motion. He filed an expedited motion to dismiss the bankruptcy. By what grounds is he saying that this bankruptcy should be dismissed? Based on the paperwork, he is saying that Miss Weaver does not have the authority to file for bankruptcy. Why not? Well, she no longer has control of the company. He has control of the company. And since he has control of the company, he is the only authorized party to file for bankruptcy. He's saying that the bankruptcy lacks the jurisdiction. She said this woman cannot file for bankruptcy. She's not in control anymore. Tennessee law dictates that the person in control of the entity has the authority to file for bankruptcy. He said that it should be dismissed for bad faith because the woman is doing whatever she can to save her brand. But the problem is what she's trying to do, she doesn't have the power to do it. So what will the judge do? This woman filed for Chapter 11 bankruptcy March the 17th. 2 days later, the receiver filed some paperwork and said, hold on, you do not have the authority to do it. Only I have the authority to do it. What do you think the judge is going to do? Well, it didn't take the judge very long because on the very same day that the receiver filed, claiming that Ms. Weaver does not have the authority to file for Chapter 11 bankruptcy, the judge agreed. The judge said, hey, listen, as stated by the court in the decision that delivered from the bench saying that the order approving the receivership, at that point, you lost your power. You don't have the ability to file for this bankruptcy. He said the receiver is the authorized party to enter into Chapter 11 bankruptcy, not Ms. Weaver anymore. So he ordered the motion to dismiss the bankruptcy case has been approved. And this Chapter 11 bankruptcy case is dismissed. Oh, Lord. So what is going to happen now? What can this woman do to save her brand? As you saw, there is more assets than debt. She has assets listed to over $500 million. She owes around $110 million. What should she do? Well, I know she doesn't like it, but she is going to have to allow this receiver to sell off the assets, pay down the debt. She will be able to get her company out of receivership, even though it's probably going to be a much smaller company. She can rescue the brand, buy back the intellectual property, because most likely there's going to be a part 2 of this episode. Most likely, the receiver is going to request that the company file for Chapter 7 bankruptcy, pay off the debts, and hopefully the Weavers can buy their brand back. Now, listen, most of you do not have a $1 billion brand that is slowly slipping through your fingertips, but you may be living paycheck to paycheck. So the Pocket Watcher is here to help. I have the Pocket Watcher 7 money rules that can help you avoid filing for bankruptcy yourself. We're talking about budgeting, emergency saving, debt planning, insurance planning, tax planning, and wealth planning and estate planning. These 7 Pocket Watcher money rules may not make you a multi-billionaire, but it can keep you from going bankrupt. So I'm telling you, go to the website pocketwatcher.net. Click on the 7 money rules. You can also sign up for the free Pocket Watcher app. This is a financial planning app where you can create your budget. You can create your debt payoff plan, and the 7 Pocket Watcher money rules is also inside of this free app. All you have to do is plug in your email, create a password, and you have full access to this app. And if you have a personal finance question, if you've got a money question that you want to run past the Pocket Watcher, go to the same website, pocketwatcher.net. Click the Ask JT button, fill out the form. And when I get time, I do the best I can to get you an answer. And of course, if there is a celebrity or influencer who has filed for bankruptcy, it could be recent, it could have been years and years ago, and you want the Pocket Watcher to break it down, put their name down in the comments of this video. And when I get time, I do the best I can to get you a video. Thanks for watching.
Are you looking for real financial advice? Thornton Financial is here to help. Certified financial planner Jayson Thornton specializes in tax and wealth planning. Are you living paycheck to paycheck with no retirement plan? Do you need help with the IRS? Book your free consultation with Thornton Financial today. Budgeting, savings, debt management, and retirement. Even tax debt settlements. Get the advice you need to live your best life. Book your free consultation appointment today. Go to www.thornton-financial.com.